Hey, Daniel, how's it going today?
It's going well. It's going well. We're switching. We're going to talk about regions today. We're talking about Europe today.
Yeah, we're
So
going to get out of the
geographic.
U.S.
Yeah,
Out
yeah.
of the
I
U.S.
think we talked about Powell too much, right? I think every cover of our video has Jerome Powell on it. So
I know.
it's like they're going to accuse us of being obsessed. Something like that. Although he is the most important man in the markets, but today we're going to switch gears and talk about some other people
I mean,
and some other events.
I almost forgot where Europe even is. I mean, is there something outside the U.S.? I mean, that we need to talk about it. This is,
Yeah. In finance, it seems that way sometimes, but yeah, everybody, welcome to Investing Counterpoint. This is our show. It's designed for financial advisors to talk about risk management, portfolio risk management, and to be a trusted expert for your clients because we live in turbulent times. If you don't know risk, you can't explain it, verbalize it, then I don't think you're going to be successful. So that the goal of our show is to help you with that using some of our experience in a particular area of risk management.
exactly. All right,
So,
so let's dig
so
in here.
Europe, right? Europe. I'll tell you it was a little bit of a surprise at first. It was a bit under the radar, but the Jackson Hole meeting that the Fed had, the biggest news, was the again Jerome Powell speech where he talked about that basically the key word for me was pain. And the world is changing
Yeah,
rapidly. I mean, I remember a time not too long ago when the goal of a central banker was to speak smoothly, to soothe things typically, right? They would never ever speak about pain. That was the Congress could talk about pain. Other people would talk about pain. The goal of a central banker was to be a soothing psychologist, psychotherapist, to calm you down, even if they were doing some, things that could actually bring down the markets. But now it's very very different. It's like it's been years when the central banks assured everybody that there's a put, right, that they're going to save the market. They've basically flooded markets with liquidity, redistributed wealth. They've done all these things, and now all of a sudden they're in a position where nobody believes them anymore.
right.
And so he said the word pain, and yet many people thought, oh, it's dovish. I don't know how you can you hear a central banker say that it's going to be painful, and then we need to vigorously, as he used some term like that, right? We talked about it in a previous video. But actually, in Jackson Hole, there were a couple of other events, and one event was a lady by the name of Isabel Schnabel, if I pronounce it correctly. She's on the board of members or directors of the ECB, and I haven't heard of her before. But then again, I don't follow ECB as much. And she said she one upped Jerome Powell. So she talked about fighting inflation, that we must defeat this inflation, basically echoing what he said. But then she went further. Instead of the word pain, she used the word shock. She said there
Hmm.
will be shocks. When I read that speech, I
Wow.
was like, do I hear a central banker, basically saying that there will be shocks? I mean, that's kind of unheard of to me. So that's when I know that there's something different going on. There's something afoot, because when you're in times past, you wouldn't hear, Bernanke or Greenspan using this kind of language
Well,
ever.
there's a difference, I think, though, for what Powell was saying, because when he was using pain, he was saying this is pain, but it's less pain than you're going to get if we don't do this. So he was saying it in a way that's like almost dovish, like you said. Well, this is a lesser of two evils, so this is the easier way. Even though you're going to have pain, but I might push the pain down the road. But if we don't do this, you're going to have more pain later. Whereas the talk of shocks, I hadn't heard this, and I hadn't heard of this woman until you mentioned that. But talking about shocks is a little bit different. I think that is ratcheting it up, like you said. That's
Yeah, you're right. Pain could be interpreted as it's like growing pains. I mean, pain is not
yeah,
always bad. Pain is a healing process in some sense, in some situations. But shock is never a healing process.
right,
Shock is never good. So
yeah,
when a central banker says there will be shocks, it's like, wait, why are you doing this?
yeah.
Why? And then she went on to say many more things that are quite shocking. Like, she talked about the end of globalization. The globalization is over as we know it. Now, it's probably all fairly obvious right now that if not over, that it's severely, dented. But again, from a central banker, it's surprising to hear such a, like firm statement that the globalization is over, that there's going to be fragmentation in the world. We're seeing the world fragment. And so her whole speech was very, very kind of doom, but it was energetic. It wasn't like, oh, it's going to be it's like, there's going to be a lot of pain and we're in the middle of it. We're going to take part of it and we're going to do what's necessary despite all this pain. It's almost like, a war speech. So how the markets interpreted that, and they interpreted correctly, that ECB rate is only 0.5% right now. So European bonds are, ECB is in a very difficult situation because remember, Eurozone was created, and for a long time, many smart people said that it's completely untenable in the long run because you have very different economies, very different, mentalities, and they're all put into this union where they have one monetary policy and they have one interest rate. So ECB has to ensure that the Greek debt, roughly has the same yield as German debt, and that's kind of crazy, right? So, and to take you back a little bit, 10 years ago, more than 10 years ago, there was a debt crisis in Europe, right, in 2010. Mm-hmm. And the way it occurred is that Greece, historically is a higher debt nation, but within Europe, Greece and Italy were not allowed to have more debt to GDP than a certain ratio that was required in Europe. And so what ended up happening, there was like a semi-corrupt or corrupt altogether government in Greece that colluded with some banks, investment banks, to sell them some derivatives that on balance sheet don't look like debt, but actually de facto they're debt. And then somehow that leaked, and there was like a whole attack in the markets, a la George Soros, like breaking the euro, breaking the pound. And so that was the first European shock. It was 2010, it was 12 years ago. It was a major shock. I mean, Eurozone was on the verge of breaking down. It ensured that Greece entered essentially depression. For Greek economy, was actually not bad. I mean, it was never like as efficient or fast growing as let's say Germany, but it was always very plentiful. The life in Greece was very plentiful. And then essentially Greece entered depression, Italy followed. It was a very tough decade for Europe. And so ECB had this near zero interest rate, and they had to buy a lot of Italian debt, Greek debt to support it, but it didn't really help the people. But for what it's worth, they kept a very low interest rate on European debt. But remember, in one of the videos, prior episodes of our show, we talked about the fact that other central banks cannot just stand by when the Fed hikes rates. I mean, it's just impossible. Imagine a short-term treasury yielding 3.5%, and ECB is yielding, all the money is going to go to the U.S.
Well, we've had that for a while with negative rates in the Eurozone, and low rates but positive rates in the U.S. So I mean,
but it's not. I don't think it's. I think this is where we came to the breaking point, and so it looks like that ECB is going to raise not by 50 basis points, but by 75 basis points. And the fact that they said we're going to fight inflation, remember historically, to quell inflation, you need to be the rate should be above the inflation rate. You need to have a positive real interest rate, which I don't know how they're going to achieve that now without breaking. You would have to really not, fighting inflation is one thing, but creating deflation is something different. Now on the net, they do the same thing, but reducing inflation is like a soft landing type of thing. Mm-hmm. Creating a deflationary spiral is very different. Yes, it will kill inflation, but will kill a lot of businesses and so on. So I'm finding, so for me in Europe, right, the cause of inflation in Europe is very, very clear. It's energy, and it's geopolitical. It's sanctions. So it just doesn't make any sense. How are they going to fight inflation that is caused by lack of gas by raising the interest rate? I mean, you're not going to produce more gas and oil with increasing the interest rate. You're just going to kill more businesses. And so that's just my opinion. And I see that in Germany, businesses are closing at a rapid rate. But going back to our portfolios, right, for your clients, what could this mean? Well, there's usually, you can have a lot of European exposure. And what they're saying is they're going to raise the interest rates very fast. Now, their other choice was also not very good, right, to let the euro depreciate essentially. because it hit parity with the dollar. It was 1-to-1 with the dollar. Euro would depreciate, and there would be high inflation, which is also a bad. But the way they're coming to fight inflation with these words like shocks and fragmentation and so on suggests to me that the central banks are very, very serious. Now, I think it's a mistake the way they're doing it, just like I thought that the excessive free money was a mistake. But now we're left with the fact that it looks like both the Fed and the ECB are going to tighten, strongly. Now, we don't know about Japan yet. Japan is another topic. They're still kind of lurking because that's the ultimate, negative rate debt.
Right.
So for your clients, what does this mean? Well, first of all, you need to think about European exposure. What will happen when rates are increased is that basically we'll see in the stress test in a minute, but there will be parts of the portfolio that will hurt. In the US as well, don't think that you're immune because Europe is very connected to the US. So the fact that the European Bank is saying that, they didn't say it explicitly, but it's interpreted that we're going to raise by 0.75% and then go further, much further, to the point of probably a shock, you have to take that into account. It doesn't mean that it's exact destiny and so on, just like we always say, but you have to run this as a stress test.
So do you think that Europe is less able to handle the type of rate increases that we've seen in the US? I mean, because you pointed out that
Absolutely.
so it's gonna devastate. You think it's gonna do some real damage to the market if the ECB follows a path like the Fed?
Sure. I mean, first of all, Europe has no energy of its own, really. They killed all of their energy. US still has fairly self-sufficient energy, could be, right? So in Europe, they're opening coal plants. They're reopening coal plants. So because the strategy was the existence of Europe was to live off of Russia sold energy for next to nothing. Now we can think that it's not because Russia made billions of dollars and whatever they were stolen and so on, but we know that these billions pale in comparison to the value that was delivered, right? It was all corrupt, of course, but like one analyst I read from Credit Suisse, I think his name is Zoltan Pojar, if I pronounce it correctly. He calculated that $2 trillion of German GDP was predicated on $20 billion worth of Russian energy. So it's like that's like a huge shoulder. That's a huge leverage, right? So in essence, you have this bottleneck. You have this amazing economy, BMWs and so on, BASF, Siemens, but you're sitting on a very small amount of money that you pay for something that drives everything. And so, of course, when the war happened and basically the sanctions hit, that energy evaporated and the whole economy is in shock. Now, for ECB, they come in and they say essentially, yes, you're in shock, and there'll be more shocks because our main goal is to fight inflation. But again, you can't fight supply side inflation with interest rate increases. You're just creating deflation, which meaning that you're killing everything. It's like curing headache with a guillotine. That's what it is. And so, it's very effective, but a bit too drastic. So, of course, it's not the level of the headache. The problem was much more severe, but also the solution could be very dangerous. And so, I propose to you that you should consider this outcome for your portfolio. For the practical exercise today, I decided to take a look at the inflation measures in Europe and see how we can stress test it for your portfolio. So I'm going to share my screen and I'm going to take a look at one chart here, which is the inflation swap, right? It's European 10-year inflation swap. Essentially, that's a derivative where one party pays a fixed rate and the other party pays an inflation, like a floating rate, in this case, inflation rate. Inflation. So essentially, the way this is priced for the 10-year is that this is like an expectation. It's not the actual inflation because obviously Eurozone, just like US, experiencing high single-digit inflation, but it is an expectation by the market. So looking at this chart, there are a couple of interesting things. I mean, first of all, you can see that It was increasing. There was kind of a drop in early 2022 because the deflationary rate, there was a lot of events that dropped the markets, and it was highly deflationary. So it was inflation expectations were dropping. But then starting in June, when it became obvious that the energy crisis is upon Europe and the world, it started going up. Note that at the end, it took a little bit of a dive. Now we're talking, when I use these terms like dive and so on, these are small numbers, right? We're not talking about percentages here. So it went down a little bit, but that inflection point here, when inflation expectations started going down again, is exactly the speech by the board member Isabel Schnabel. That's exactly it. So you can see that. What can we draw from here? Yes, the inflation expectations were rising in Europe, but they're going down after the speech. But also we should see that this is very low expectations, right? Essentially, market participants think that this inflation of 8 or 9% that we're seeing is completely transitory. Where have we heard that, right? I've heard that word many times. So I don't know what's going on, if this market is being manipulated or so on. I think it's strange to me that, given the fundamental structure, right, that Europe is not going to buy Russian energy again. We know that. I don't think politically that's untenable. They already said all these things. It's not like there are new sources of cheap energy that you can find. There is energy, but it's more expensive. And so energy inflation is necessary and basically unavoidable at this point because of all these actions. So how can market expect that for the 10 years the inflation will remain at about 2.4%? Well, one idea is that maybe they believe that ECB is very, very serious, and if they need to, they will break the market.
Right, exactly what I was going to say.
So going back to stress test every couple of episodes, this is portfolio crash testing, is software that we've built for financial advisors to manage risk, to explain risk to clients. And I'm going to show you here a portfolio. It's kind of a moderate portfolio. See, it's got a balanced risk allocation from Invesco. It's got a Fidelity, Spartan. It's got some government bonds. It's got a core bond. So it's a very moderate portfolio. Let's say, not terribly risky. So, and I have Eurozone break-even spread here. Now, break-even spread is not the same thing as a break-even swap. Essentially, break-even swap is a component of it, you could say. Break-even spread is the difference between the nominal and TIPS inflation-protected yield. So you could see that this break-even spread in this particular graph has volatility of 1. What does that mean? We show that to you in portfolio crash testing to tell you what kind of move you can stress test. Because if you're going to stress test a 10 standard deviation move, the volatility is the same as standard deviation, well, then you're really out of bounds of historical record, and the math doesn't work as well. So the idea is that you want to stress test 1, 2, 3, with 3 being a very large shock. And then you can do 4 or 5, but those are extreme shocks. So I'm going to try to see what happens if the spread narrows significantly. Okay, let's say it narrows by 2%, so 2 standard deviations, so a big move, not a world-ending move, but a big one. We can see that this very moderate portfolio will drop about 10%. In this case, dollars and percent are the same because they have $100. So 10% drop with nothing winning. So no, basically break-even spread in Europe doesn't help any of these bonds. I mean, arguably, if you had inflation-protected securities, this would work. This would work better. You would have some cushion. So what does this tell me? Well, we talked about ECB is definitely on course to fight inflation no matter what, probably cause deflationary recession, kill a lot of businesses, and fight inflation by basically drowning out the economy in some sense, because they can't fight supply-side inflation with shocks. So they're going to do that. And we saw from the Bloomberg chart that the market break-even swap, the market kind of expecting that. It never really went up. The inflation expectations never really went up. So you could almost say that people knew, I guess, that they wouldn't let it happen. And lately, the inflation swap started dropping again, right? I showed you in the previous chart. Now we took a moderate portfolio of the kind that your client could possibly own, not these exact names, but a similar structure. And we went into portfolio crash testing, and we created a similar test with break-even spread in Europe, 10-year, dropping essentially 2%, right? So 2 standard deviation move. And significant. So if ECB continues, that's what we're going to see, right? If they're going to continue to go through this, we're going to see a big move on the downside if there's deflation. And even a very moderate portfolio has some vulnerabilities, 10% risk. You could see that Invesco balance, obviously, Spartan S&P 500 is dropping, but even the government bonds are not doing very well in that environment. So this is a dangerous environment. A typical 60-40, right? This is not a 60-40, but you can think of it's not that far from a 60-40 portfolio. If you count.
50-50.
Huh? About
It's probably a
50-50,
50-50. Yeah.
So, but even like a 60-40 portfolio that is thought to do well in different environments, this is the environment that it will not do well. You cannot just rely. So the lesson is you cannot rely on asset allocation to do your work for you. Most environments you can, but in this environment you have to look much closer, much more granular. Look for instruments that will cushion the blow, whether it's tips or something else. You can comment on the video what your thoughts are, right? You're professionals. Given what we said, you agree, disagree? What would you use in this portfolio to cushion the blow a little bit? Because if a moderate portfolio drops 10%, then a fairly aggressive portfolio will drop much higher, much more, 20%. So ask questions, make suggestions, but our analysis for you is that ECB situation should not be ignored. It's going lockstep with the Fed, and it will probably produce some very serious consequences, even outside of the Fed. Okay.
Yeah, that's interesting. So maybe next week. So keep in mind that's also a U.S. centric portfolio. There's a international value portfolio in there.
Cross correlations.
Absolutely. Just because you do something in Europe, something happens in Europe has an impact on the U.S. The markets are intertwined. I mean, these things don't happen in isolation. They don't happen in silos. And this situation in the ECB will impact your clients. And what we need to do is try to take a look at, and maybe we can do this next time, Daniel, we'll try to take a look and see if we can find something that has a relatively low correlation to some of those other instruments, something that might be expected to do better
we have tools to do that. We should look and then present, what would be the instruments theoretically that could help out. But from us at RiXtrema and Investing Counterpoint, thank you for watching. We wish you to stay strong during those times and be an expert, be on top of your game, and win new clients and keep your clients as well.
Great, thank you.
See you next week.